The U.S. government is running out of money to pay off the debts it has already racked up. To make the payments and avoid defaulting on those debts, Congress has to approve a debt ceiling extension. The Congressional Budget Office says this has to happen this summer. House Republicans have a bill that would lift the debt ceiling into 2024 in exchange for spending cuts. The White House says it strongly opposes the measure, and President Biden would veto it if it were to land on his desk. As the deadline approaches, the political divide in Washington could create headwinds for capital markets and the economy. Jeff Stein joins me for more. He is the White House economics reporter for the Washington Post. Jeff, last week, Speaker Kevin McCarthy went to the New York Stock Exchange to be in front of that symbol to try to put market pressure on the White House to negotiate on this question of spending cuts in order to get a debt ceiling increase. Is the market reacting? Is it putting that pressure on President Biden?
We are starting to see this week the very earliest signs that investors on Wall Street are beginning to see some real risk here. We haven't seen really equities and stocks fall yet, but we are seeing some volatility in the bond market, which is a reflection of uncertainty about U.S. Treasuries, which are the debt that's issued, as part of the debt limit. If once it gets raised, they can go forward with those debt auctions. And we're also seeing sovereign default credit swaps. Basically, people are hedging increasingly in markets that the U.S. will default. And so you're seeing investors begin to do that. Overall, though, I think it's important to stress markets are really not reacting to this just yet. And I think that reflects a sense of complacency on Wall Street and elsewhere that they'll get this done. I think that complacency seems very misguided at this point, that we don't really have much of a reason to think they'll get this done. But there's a catch-22 in that lawmakers feel no pressure to act until Wall Street starts to freak out. So that's the bind.
Yeah, let's linger on that for a moment. When Silicon Valley banks collapsed, the market panicked a lot. But we get constant warnings about what would happen to the economy if the U.S. defaults on its debt. The Treasury Secretary reiterated that point very recently, and yet the market doesn't seem to be worried. That seems like a disconnect.
Yeah, as someone who's covered Washington for only a few years, it's already become incredibly clear to me that the only thing that really gets Congress to move with rapidity, be it during the COVID economic crisis or really in 2008 or maybe even, as you're alluding to with the SVB collapse, the only thing that really scares them into immediate action seems to be a collapse on Wall Street when donors really begin to freak out, when, to be fair, middle-class people also see their 401ks evaporate overnight. That puts immediate political pressure to act. And so we are left in this frustrating limbo where, because Wall Street is confident that, this just gets done again and again, there's always debates in Washington over this, but lawmakers always rally. But the thing is, the lawmakers always rally because Wall Street acts. So yes, I'm glad you dwelled on that point, because it is maddening to consider.
And back in 2011, when there was a showdown between congressional Republicans and President Obama, there was no default. But as the date got near, the markets plummeted, interest rates increased, and the country's borrowing costs went up $1.3 billion. Is there a similar scenario? In other words, there were economic costs without breaching the debt ceiling or the debt limit. Are those costs possible to start accruing, and might that get some movement?
I think we're really a few weeks away, and maybe fortunately, unfortunately, depending on how you look at it, from any economic impacts from the failure to raise the debt limit. And maybe people will throw this back in my face later, but I think if we escape this current standoff with the damage from 2011, a lot of people I talked to at least would consider that to be a relatively healthy outcome. I think the sides are so dug in on this point. McCarthy has such allegiance to the House conservatives who have said you must make huge changes to the federal spending or we will dethrone you as Speaker. So McCarthy is really in a bind. The White House, I think, understandably does not want to reward this kind of hostage taking of the U.S. economy to make changes that they regard as terrible for millions of poor people everywhere across this country. And so I think if the worst we have is a little bit of economic damage and a little bit of a credit downgrade, the kind we saw in 2011, that might be a happy outcome, unfortunately.
A grim, happy outcome. That's the state of things. Jeff Stein, thanks so much for being with us.